Good afternoon, everybody, and welcome to the Blue Sky Business Acquisitions Podcast, Episode 5. Buyers, you bought a business. Congratulations. Now what? And today we are blessed to have both our sponsor and our co host on our podcast by the name of David Carbala. David is with Squash CPAs. Smart deals start with solid numbers. Squash CPA offers next generation quality of earnings and due diligence to help you navigate your deal confidently. Get started at squashcpa.com. And without further ado, I'd like to introduce our fearless co host here, David. David, AKA Squash with Squash CPA. Floor is yours, sir.
Perfect. Thanks for having me, guys. It's a lot. Big fan of the podcast. So I'm honored that you guys invited me on. But
Excited to have you on.
Absolutely.
Very excited.
little about my background. So Squash CPA, next generation accounting firm. We're focused on bringing AI and automation to traditional accounting services. So my practice focuses on financial due diligence, quality of earnings, and forensics accounting, and then I also help out with some business advisory work. So my background, I started off at PwC, one of the large accounting firms. Started off in the risk advisory group and then ended up ultimately in their global innovation team. And so a lot of what I did was just a lot of transforming the industry of bringing technology to accounting, and kind of got to be on the ground front and center to see all that. And so it was like one of the projects I ended up doing was we do a journal entry fraud assessment for all our audit clients globally. Usually takes about 200 to 400 hours. We were able to automate that down to 4 to 8 hours. And so that's kind of one of the things that I got to see front and center to how to transform the industry. And it was a great time because it was one of those, the accounting industry has not been touched by any automation or technology. It's still your old school calculators and pocket protectors and all that fun stuff. And it's changing, and it's slowly changing. But I kind of got to a point and I said, I don't really want to become a partner. I got 4 boys at home under the age of 7, and I kind of want to watch them grow up. And it's a large time commitment, life commitment to kind of go down that route. And just kind of looking around in that, at least in the Wisconsin market, we kind of see that lower middle market underserved right now with a lot of consolidation happening. So you kind of see that you're either a accounting firm, solo person with 600 tax returns, and then it jumps up to a regional firm. And so I said, okay, with technology and kind of see the gaps in the market, I said, I think this is my opportunity to kind of jump in and say, hey, this is my opportunity. And I've been doing it about a year now, year plus, and it's been great because you have the flexibility of kind of being that self-employed type, and you get to help out people in different ways. But I think the other thing I've also enjoyed too is helping people with their acquisitions, because it's been a heavy burden to people, because one of the things I've seen is you get a quality of earnings and it's going to be 60 grand and the acquisition's like $2 million, and it's like, oh crap, like I was trying to put that money into a down payment, right? And
Right.
with this, I could speed up the process, offer a lower price point, but then instead of me just shoving a report at you and say, hey, good luck with your acquisition and walking away, I can help people along the way in their acquisition process and almost be like a buy side, sell side advisor with them. Not taking away business from you, Matt, but
No, and it's a good point, Dave. I mean, we've referred plenty of buyers over to you to do their buy side, quality of earnings, and we've got nothing but super positive results, which brings me right into what does a Q of E do for a buyer? They buy that business, we close on that business, right? Ben does the loan, and now you're 30 days in, you're 60 days into that business. Things that come to mind of what's next is working capital expenditures. Do you over leverage? Are you under leverage? Do you lack financial guidance in the market? There's a lot of different things that are there. So, With that, David, you got our agenda. I'd love just to hand this over to you and start wherever you feel comfortable talking about you bought a business. Now what?
Yeah, no, I think working capital, it's especially in the acquisition process, it's kind of a concept that some folks struggle with. But overall, it's like what is the day-to-day funding required to operate a business, right? And it's like, what the heck does that mean? I think if I use an analogy and say, hey, think of buying a business like buying a car experience, right? You kind of look at the features and see the opportunities and how I can use this. But I I would say comparably, working capital, that's a discussion of, hey, I'm buying the car from you. How much gasoline is going to be left in the car before I leave? So if you buy a car with zero gasoline, the buyer has to come in and say, okay, how do I get this off your lot? Like, do I have to tow it? Do I have to bring one of those gas cans and, and fill it up myself? Or do I need to push it down the street to the nearest gas station? And so that's kind of the one end of the spectrum. The other side of the spectrum is, hey, the seller, like, typically there's $1 million in gasoline there. Now we've had a good couple months and there's $2 million. And then the seller says, well, I want, like, there's excess gas sitting in this tank. I want my money back. And so that's one of the things as you're going through the process, you kind of think about, well, how, like, that thing about it is how much gas is left in the tank.
No, and that's a really good analogy, right? And I think you touched on something there that a lot of buyers ask us, and I know Ben, you see this all the time, right? Is the working capital analysis. So from the chair of a CPA, someone who's doing these Q of E's, what is your calculation for working capital?
Okay. So I'll break it down into each category because I think it's it's hard to say, like, because people always come to me and say, hey, what's the number? And I'm like, well, it's more of like an art than an actual science. Because like if you kind of break down each section and say, hey, like the first section, like let's talk about accounts receivable, right? You invoice someone, they pay you in 30 days. But that number, working capital number, can change. So if you own a snowplow company, right? Your peak time is when snow's on the ground. And I've yet to see it snow in Wisconsin in the summer. And it's like, well, how would, like, not much money's
Still,
coming
it's
in.
still Wisconsin, and it can still happen.
Yeah,
It's
I've
40
not seen
degrees
much snow in
today.
Wisconsin then, but then it's like, well, I need money to cover payroll and my insurance, my lights and utilities. And it's like, okay, well, let's think about the seasonality along the way. And so, like, when I do due diligence job, I first, the other thing I take a look at is like, let's see what's actually there and see it's high quality and you're actually going to collect on it. Because there's plenty of times where you get a receivable listing of, hey, like I got $2 million and this is what the 2 million is made of. And then you start looking and you say, hey, this thing hasn't been collected in 2 years. Don't buy this, right? If it's not been collected in 2 years, it's definitely not going to get collected when you take over and buy it. So it's definitely not worth the full price of that receivable. So just
Good point.
watching out for those. It's because I've seen that plenty of times, and there's ways to mitigate it through the process, but also taking a look at, like, I had a client recently who owned a home construction business, and he also owned a plumbing business. So there's a lot of transactions between his home building business and plumbing because there's a lot of synergies between the two, and he's carving out his plumbing, and you saw a lot of receivables just sitting there, and it's like, dude, you owe yourself, and you're trying to sell me what you owe yourself. And so taking a look at those, we call it related party transactions, and so just clearing those out before you actually buy the business, or even factoring that in after you sell, like, buy a business, and it's like, okay, like, these aren't real because it's just me owing myself, and I just click the button to send the ACH from one account to another. Um, Another big thing, I think this one's interesting. I'd say you when you do send out an invoice and you put it out for 30 days payment due, and you kind of become like a mini bank. So you also have to factor in, like, there's a credit risk. So if a lot of your customers, like, hey, this customer is 10 to 20% of my balance, you have to start saying, okay, what's the likelihood of this customer going bankrupt in the next 60 days? And so it's those types of scenarios of like, if there's too much aggregate risk in a couple of customers, you also have to factor that in. And because if they go under, you might get paid in bankruptcy court like in 180 days and a year later. And it's like, if you're looking for liquidity, that's not happening. But I think the other big thing too we've done on the accounts receivable side too is taking a look at days sales outstanding. Usually people look at it as an overall metric of, hey, how long is it taking me to collect on my invoices, and kind of getting an average. Like with my firm, we take a look at it by customer. So if we look at the history and say, hey, how long have they been taking to pay in the past? And because that's going to adjust your working capital needs. So because with closing, like you want to get to close as quickly as possible, but like it might be like on a Tuesday in the middle of the month, and you take a look at what's actually outstanding, and it might be, hey, all the easy collections are passed, and it's just a bunch of people that take usually 60 to 90 days to pay you, and it's like, well, this isn't coming in anytime soon. And so you think about, how do I fill that gap? And it's just even on the accounts receivable, like there's so much thought that goes into each piece, and it's a lot of people just get lost and say, hey, just current assets minus current liability, they just call it a day, right?
Right. Yeah. No, I mean, I think, what like we do as brokers, we look at, cash in the bank plus accounts receivable plus inventory minus, accounts payable. And we kind of get to a number, and we average that out, and we say, okay, well, based on this, your working capital number is X. I know the bank has a certain way of doing that. So when we look at the receivable basis versus the payable basis, the one factor that is really important in a lot of these is inventory.
Right? Yeah, and this one's interesting, because I think the number one thing you need to look at is what type of system they have set up. And it's not like, hey, what a ERP system? Is it a periodic or a perpetual type system? So when you hear those terms, it's the periodic. You get business owners at the end of the year and say, hey, we're going to take a quick inventory count and make an adjustment to inventory balance. And like, you'll take a look at financials and kind of see the same balance for inventory. That's kind of the first sign of saying, hey, this is probably a periodic one, because they're not really looking at it. And then the next one is the perpetual, is you spent the money on an ERP system, and you can go into your system any day of the week and say, how much of these widgets do I have on hand in my system? And I expect that to be out on the floor. Because with the periodic, you get the higher risk, right? Because if you're only counting it once a year, there's a lot of things that could happen. Like things could become obsolete. There's leakage, like employees steal, like it happens, right? It could be damaged, someone kicks it or drops something on it, and you just lost, I don't know, two grand worth of inventory, right? But yeah, that's the first thing we look at. But I think I kind of touched on the topic of the slow moving inventory. I think this is one of those, it's kind of, you gotta kind of use a little bit of common sense. Like hopefully you're taking a site visit and kind of taking a look around and saying, okay, what's here? Because there might be like an old, I don't know, like a old door that there's a stamp that says produced in 2021. And you kind of have to scratch your head a little bit and think, well, if this guy hasn't sold it, or this person hasn't sold it in 4 years, and they're trying to sell me this door, the probability of me selling it when I acquire this business is unlikely. And so that's the type of stuff. It's like, okay, we got to make a nice little adjustment, say, I'm not buying this door that's been sitting here for 4 years. Because ideally you want to buy things that you can sell quickly. Because I think I'll jump to the next point, but I think, because it kind of leads into the obsolete inventory, right? Like you kind of have to pay attention to the shelf life. Like if you're buying a flower shop, flowers don't last forever. They got 2-3 weeks. I have no clue, but they don't last long. So it's
someone's not buying his wife roses very often.
Yeah.
David, I have
don't tell her that.
I have a question.
Yeah, go ahead, Ben.
And great topic on the doors. I don't know if you know this, but in Savannah, if the door is painted red, that means the house is free and clear. So I want to like, a lot of what you talked about is accrual accounting, right? Where you're able to easily discern working capital. But what do you do in situations where all the books and the tax returns are on a cash basis and there's not really an accounts receivable, payable, or inventory report? What's your methodology you use to test working capital in those situations?
Yeah, so with that, it's you have to look at the financials, kind of looking at the inflows and outflows of every month, right? It's like, how much do I need for payroll? How much do I need for all this stuff to operate my business? And so typically I've just kind of done like a 30-day moving average of, hey, let's take a look on what's being spent on and just get a rolling average on that. Or it might just be like a smaller business, or it's very simple and say, hey, I have usually 50 grand a month, and you can consistently see every month we're doing 50 grand, and it's like, well, how quickly am I getting paid? And one of the things you kind of factor in is like, if you're like a restaurant getting paid on your POS system and you get paid 2 days later, it's a lot of dynamic variables. It's all business by business, but I think this is why you work with professionals along the way to say, in this type of business, it makes sense to have this type of working capital and like a more longer cash conversion cycle. Because at the end of the day, like in an acquisition, you are just trying to get enough working capital to meet the next 2 to 3 cash conversion cycles. Because the worst thing that can happen to you is you're going to sink the boat, not have enough money, and you're running back to your banker, Ben, and say, Ben, I ran out of money. You just gave me a ton of money to acquire this thing. I need something short term.
So
Remember your debts, people. Remember your
Yeah.
debts.
So cutting further into that conversation, David, do you have like when you're talking with a potential borrower / buyer, right? Do you ever look at it and say, okay, this is your revolving working capital and this is what you need to have cash on day one, permanent working capital?
Yeah, and so that's I think the conversation of how much gas we need in the tank. We have that as part of every package along the way. Like, hey, how are you funding this thing? Is it cash out of pocket, which would be awesome in all situations, but what type of SBA loan? And so it's working the CPA, working with the banker, working with your advising team, and say what's the nice capital stack, is they like to call it, in your deal, right? Because it might be, hey, I didn't put that much down on the loan and business, but I have an extra 200 grand sitting around. I don't want any of this person's working capital. Versus, hey, let's bake in money into the SBA loan for working capital as well. It with a lot of inventory and large AR balance, it becomes a little more difficult because it's depending on the size of the business plus working capital, you might exceed your threshold there, and you might have to look for other financing options. With banks, they may put out like another conventional loan, or you may see a line of credit along the way that they hedge against the AR inventory, because a lot of times you see like, hey, 80% of your AR can be loaned out and 50% of your inventory can be loaned out. So it gives you a bunch of different options.
Well, that gives you a really good transition, Matt, into your next couple topics, right? MCA and factor, right?
Correct. One of the big things to the listeners out there, you bought a business, you get into large project management. I'm working with a guy right now. He bought a large commercial window installation business, and he's crushing it, doing a great job. He looks in his account and goes, I don't have $250,000 to fund this. So he calls me up and says, hey, what am I going to do? And I said, look, you got a couple of options, right? We can look at getting you a revolver. We can look to stack this on your SBA loan in some capacity in a subordinate nature. We can look at factoring. There's products out there called MCA debt, right? Which for the new SBA SOP, Ben, correct me if I'm wrong, MCA debt cannot be refinanced with an SBA loan.
Yeah, that is correct. It is ineligible.
So as a cautionary tale to all the buyers out there. But I think at the end of the day, we talk about, you bought a business, you're figuring out your ERP system for your inventory, you're figuring out your QuickBooks or your way of accounting, right? And you're invoicing. You got, maybe you even have WIP, work in process, right? And so you're progressional billing through some items. But Dave, how many times have you seen clients buy a business and 6 months later they're saying, I got a project and I'm going to go get MCA, and then they over leverage themselves.
Usually MCA is my last option, but I've seen that scenario happen many times, but usually in the good way of like, hey, traditionally I've gotten $300,000 projects, and now I got myself a $2 million project. Like this is huge for my business. But the problem is it takes more material, it takes more manpower, it takes more logistics and money up front. But ultimately, then you have a $2 million collection at the end of the day, which that's the other part of understanding your cash conversion cycle is how long do I need? And so a lot of times banks love that problem of, hey, you have contract in hand showing them, and it's like, yeah, we know this is real, right? But yeah, the MCA, it's a balance, right? Because it's really like you're kind of selling your soul for a lump of cash, and then ultimately you're saying, hey, I'm going to exchange sales in the future. And so they'll want to get paid weekly, monthly, but they'll use like a factor rate, and you'll see the number between 1 to 5. So it's like, hey, like, and so, hey, let's apply it to the future cash sales. But with something like, hey, like the example I was providing, you're growing, like you don't want to sell your future cash flow. And on the flip side, if you're losing customers and losing sales, it's just going to eat up all your working capital. So I usually don't recommend it. I highly recommend, if you want to go down that route, you work with another professional to kind of give you a spot check, because even just signing up, like whoever's selling it to you will say it's a great idea, and I get it. But you got to read the terms to it, because there's a lot of different terminology in there and it gets very confusing. And so that's why I highly recommend working with a professional that's kind of a third party and say, hey, does this make sense for my business? Because you'll sign yourself up with the devil on that one.
Hey, Matt, like on the factor side, like the thing with the factor, switching from MCA over to factor, is like sometimes on an acquisition, a line of credit may not be the option, and the factor is the way to go. The factor, what it does for you is they buy your receivables. They're essentially underwriting your customers, and you get the margin back right away. And so it can be an option for someone that doesn't have the ability to get a line to be able to sell their receivables to get cash quickly. And then the factor company handles the collection of that receivable, and there's treasury management services. So it's in some ways, if you're not disciplined, it's a very disciplined way to manage your cash flow and have someone else handle your receivables. I have an opportunity I'm working in right now where the need is like $2 million, right? From a revolving standpoint, right? And they're using a factor, and they're going to continue to use a factor. And so there's the ability to exclude the accounts receivable on that deal and have the factor take the receivables.
Yeah, and just to add on, but that you see that a lot of trucking companies with factoring is a very common practice where I like in that example, like not having a whole collections team, they're just focused on delivering growth and expansion, and something like that. Like it'll cost you like 1 to 5% a month, but you get cash right then and there. And especially with those long cash conversion cycles and kind of wrestling clients and saying, hey, I need to get paid, like those back and forth phone calls, like you have a whole third party handle it. and they'll tell you if it's a good credit worthy customer, because they have a vested interest in collecting on all that.
To me, it seems
Right.
like if you're needing a factor loan, right, fairly quickly after acquisition, it's a sign of deeper cash flow issues that should have been addressed during the acquisition. But I mean, certainly seems like a good short-term financing tool for the right business, for sure.
Yeah, absolutely. Mm. So there's no blanket answer. It's kind of depending on what's going on with your business, right? Depending
No,
on what type of
100%.
business.
Yeah, I mean, 100%. We're just putting out the options, right? I mean, they're both really good options for buyers who are in growth mode. I think another good option that we see a lot is buyers that are looking to divest equity and bring on investors. So in a lot of cases, David, you're doing quality of earnings and you're looking at sell side that, let's just say, they've sold off chip by chip by chip by chip of the business. What is your view from a quality of earnings, and do you think selling off quickly is an important thing?
With the overall, just the overall business, or specifically with the
This
receivables?
the overall business. You got the investor that's coming in saying, "Look, I'm going to invest money. No need for that secondary bank financing, but I'm giving up equity."
Okay. No, it's if they're selling it off, it's kind of it triggers what's going on, right? You kind of want to understand the motive behind why it's happening. Especially like you start seeing assets get sold off, but if it's purely just like cash injection, it's like you really want to understand, well, what's the purpose behind this cash injection? Like, is it for growth, or is it to operate the day-to-day business? And if it's the latter, like that's where you start asking the questions. Well, what's going on? How, like, as someone going to come in to buy this thing, how am I going to fix it? Because that's the first sign, is I'm taking this money to operate day to day. And it's kind of one of the quick signs of that this business is over leveraged.
Sounds good. You said this earlier, working with a financial professional to help you, right? And I mean, I'm in my 20th year of doing this. I've seen clients time and time again lack the financial guidance needed to operate. People that don't want to go out and find a bookkeeper, or they think they can just handle it because it's simple accounting, right? I think, for our listeners out there that are buying businesses and they're looking for avenues of growth, factoring, MCA, investor debt, they all have a certain place. But I think touching base with that industry professional to put you into a position of success, have a secondary set of eyes on it, is probably the wisest thing that you can do.
I agree. I think that some of the biggest mistakes that I see on both buy and sell side is not having a team of advisors, going into whether they're selling or buying, right? And they get so far down in the process, and then all of a sudden they realize they're in over their head and are scrambling. And potentially an asset purchase agreement's already signed, so, what mistakes do you see, especially because we're talking more about buy side and post acquisition, buyers make in the process?
I think the most important thing is to put together a good team. And so what does this team look like? It's not just getting a CPA and all your problems are going to be solved. I think it's a combination of things. Is, hey, let's get a CPA to do some tax planning and compliance and see, do I need to change anything in my business? I just ran into a business the other day where they're losing 5% of their cash flow because they're paying taxes on it. Because in Texas, you have to pay for material sales tax, and then the service there's no sales tax on that. But when they invoice the client, they lump it together, and then all of a sudden you're paying 5% on the service as well. And so something as simple as that, like could solve a lot of your problems. But with having that type of like tax advisor guidance there, and then having like a a bookkeeper, an accountant, because, and honestly, like, I know everyone gets the urge to kind of, hey, I can handle my books. It's my books, and but you'll ultimately spend, I don't know, 5 to 10 hours on it a month. But would you rather have someone take care of that for you? I don't know, for $500 a month, or you spend that 5 to 10 hours getting one more additional sale, which you get way more than $500, right? Like it's you think about the old economic opportunity cost. Because in with that too is having your books organized is important, because there's certain scenarios where if you have organized books, you can go get loans quickly. You can take you can you see an opportunity to acquire a business. It's like, well, you have a week to decide to go talk to a bank, and they're going to say, hey, what's up with your financials? And you just lost that opportunity for an additional add-on to your business. The other big example I see is I talk to clients about R&D tax credits. So there's opportunities that you're investing in new technology or new process. But the important thing with that one is you have to have your costs kind of broken out and say, hey, these are my operating costs, but these are my R&D expenses. And most clients don't set themselves up for that. And it's a pretty good chunk of up to 20% savings right there.
Yeah, Section 174, that R&D credit you get is critical. And I mean,
Yeah.
we see manufacturing companies all the time that are, they have an engineering department that are scheming, trying to come up with a new product or a new gear or a new widget, and they're not taking advantage of that credit. And I'm just like mind blown. I'm like, you guys
Yeah.
realize you have this ability. And
It-
Wisconsin's an extremely pro manufacturing state, so there are grants and credits out there for you.
Yeah.
So
It's one of those, you have a partner along the way, and that's on the financial side. I think the other piece that you need on your team is having an insurance broker, to help you kind of manage those costs along the way. Because the worst thing you can do is the first time calling your insurance broker is when you have a problem. Like, hey, a plant just blew up. Can you help me with this? And it's like, you barely know this person, and and usually you have to have a heart-to-heart conversation with that person of like, help me mitigate my risk along the way. The other thing is start establishing a relationship with like a business and corporate attorney. Just
Oh, yeah.
having someone kind of understand your business, at least putting together like an operating agreement once you first start, just figuring out how that's structured. And so in case those scenarios of, hey, this employee is suing you for wrongful termination, you're not sitting there in a panic trying to shop around for an attorney and see who I trust. Like, you have someone in your back pocket that you're calling right away. With that, like, I also recommend having a nice estate planning attorney, because if you wake up one day and just kind of get hit by a bus, and like your business goes straight into probate, and every day it sits in probate, the business value just drops, because everyone's sitting there waiting for the court to assign access to some attorney to get access to your bank accounts. And so every day that goes by, like, who's running the business? And with an estate plan, you figure out, okay, if I'm not here, this person's running it. My spouse, they can have access, they can keep going with it or sell it. This is who I want to sell it. And so just piecing that story together in case the worst happens. And I think another one is having a good wealth advisor. With that, like, I know everyone's out there operating their business, figuring out, hey, like, what's the best way to make revenue, but someone's got to think about your personal life. That person's going to help you think about, hey, what's my exit look like? How long do I want to work? How much money do I need to keep saved away? And you can also, the good ones will help you also with a business financial plan, kind of saying, hey, this is what I'm thinking. And so just having a good partner there. And then I think the last piece is having, I wouldn't say you need to put this person on your board of directors, but it's having a good business advisor or a fractional CFO to kind of say, hey, how do we measure success in this business? What KPIs are we tracking? Are we looking at profit margins? Are we looking at customer growth? Like, and start establishing some of these KPIs and say, how do I measure today versus yesterday and in the future?
So David, you talked about building your foundation and your bench, right? But one of the things that I see at post acquisition, right, is all these people helped the buyer, right? And then that team kind of disappears, right? And that buyer doesn't go back to that resource. So maybe you hit on that part as well, of like the part about you built this foundation, keep these people in your book, in your Rolodex, right? Because they're going to help you long term. That business advisor, I think that's one of the most important things post transaction, because who does a buyer go to that they can share some of the things that they're going through as a business owner, right? Like
Mhm.
they're 18 months, they're going to go through a lot. So like maybe
Yeah.
you can hit on like keeping that team in place.
No, Ben, you actually brought up this story with another client the other day where it's like, when you buy a business and go through that post integration process, it's kind of like leaving the hospital with a baby. Like all the nurses and the doctors are so helpful, but then like you kind of get to your car and you put the baby in the car seat for the first time and you're like, oh crap, this is real.
How do I
And it's
change
the
the
exact same
diaper?
way with the business. So good luck.
And no one's helping you then, right?
Yeah.
Yeah.
Well, I think you segued and you touched on a lot of really great points and topics for our listeners out there. And the one thing that as a business broker, I would just like to remind everybody is you buy a business, you have to ask yourself, what does your exit plan look like? And the crazy thing is on day one, you should know what it's going to look like to sell that business. You bought it, now you want to plan the exit, right? Because like you said, you wake up in the morning, you drive down the street, you get hit by a bus. Well, you're starting to tickle on those dismal D's, right? Death, divorce, disease,
Oh,
right? Dismemberment. I mean, there are a lot of things that happen in a buyer's life that could derail the train. And so having a solid exit plan as well as a solid growth plan, I think is absolutely key and crucial. And so with that, what if we just kind of go around the horn here, guys? What are some stories about post-acquisition nightmares? The major pitfalls that buyers fell into or stumbled into?
Well,
Silence
you
is
started
Well,
off so
golden.
negative,
look,
right?
I think
Sounds need to be
Matt,
cut.
I think Matt, that like look at post. I think the biggest thing, right, is David hit on a point earlier in his discussion, right, about like that part in Texas about like the the sales were all being recognized under one category, so the Texas sales tax was applying to the entire sale, and they were losing 5% of their profit, right? Like I think in diligence, like even with the best diligence out there, things get missed, right? But having the right team in place for the buyer to quickly catch that early on in the process is the difference between making it and failing. And that's what I mean about that foundation of having the right advisors and the business coach that is regularly checking in with you, and like spending money on a business coach that as a business owner you're like, oh, I just did all this stuff, like how can I afford this business coach, right? But how can you not afford the business coach? Because they could be the one that through those weekly meetings addresses and catches that with you in your conversations and allows you to make that change so that you don't lose that money, right? Or you don't overspend on like advertising right out the gate and blow your working capital right out the gate. You control your use of the working capital. So like when I see situations where there's challenges, right? It's a miss in due diligence, or it's not understanding the controls that you need to have in place early on to help you manage your business and not having the right advisors.
I think that's a great point. Look, if I'm going to buy a business, one of my first hires is Squash CPA, and making sure I have his eyes and his knowledge and his back end software that he's created and is humble enough not to really bring up, but to analyze working capital, and make sure that I'm going to know as much as I possibly can about the business before you're actually taking it over. Finding out little seasonality that, is there seasonality? Sometimes some businesses like, snow plowing, right? It's pretty obvious, but others, you'd be surprised. There may be some seasonality or, CapEx. I mean, maybe the seller has large swings in CapEx every other year, right? And how do you analyze that? How do you smooth that out? Can you smooth it out? When are you going to need to, outlay capital for, new equipment or whatever? So, yeah, I mean, having Squash CPA on your team is never going to be a bad thing. And if anything, it's going to save you a ton of money potentially if you're buying the wrong business. Or if you buy the right business, you just know that much more so you can take it to the next level.
Yeah, I wanted to touch on the topic of the CapEx real quick, but I think you get a lot of people looking at acquisitions and you have a lot of these aging boomers kind of just riding out the wave and don't really reinvest in the business. I'd say that the biggest thing with CapEx right now is pay attention to how they're reinvesting in the machinery. Pay attention to that repairs and maintenance, because when you take over, you need to replace that machinery. And if you don't, yes, you have working capital kind of take care of you for the next 2 to 3 cash conversion cycles. But if you need to buy $1 million machinery, you need to plan for that. And that's something you need to factor in as part of your acquisition plan. Because usually one of the exercises we go through is we say, okay, here's a list of assets that have been acquired in the past 5 years. Is it related to replacement or is it related to growth? Obviously, the growth is great because that's how you fund your future cash flow and get an ROI and all that fun stuff. But if it's just to replace the business and you don't see that much sitting in that bucket, you have to ask yourself a hard question of, well, how long is this thing going to survive on the floor before I need to replace it?
Super great points. I think too, I mean, CapEx is one of those things that a lot of people don't take into consideration, like you just said, right? But it's the number one thing that can offset you. Right? We sold a business a few years ago, and the buyer gets in, and he has service records on the vehicle, the van, and the engine blew, transmission blew, completely a fluke. But then he has to turn around and say, well, do I repair that transmission or do I go buy a new van? Right. So there's going to be things that are outside of your control after buying a business, but there are definitely things that you can control going into the acquisition that you control after the fact. So very good points.
Yeah. So just to add one more thing is if you're doing 90% leverage deals with SBA, like you got to remember SBA is taking all those assets and you're underwriting against them. And so you can't underwrite and use it for another loan later on down the road. You have to completely purchase a new product or machinery along the way. And if you buy it, if you need machinery the day after, it's a hard conversation with the bank of, hey, I already leveraged this business 90%, but I need you to provide me more tomorrow.
Ben, first lien positions, bud.
But no, with your, I wanted to add one thing to your exit plan. The truth is you see a lot of people, they kind of just keep running their business, and like running your business until the day you die is not an exit plan. So realistically, like that's where I mentioned before, it's sit down with an estate planning attorney, sit down with a wealth advisor, and figure out what is the day I want to go retire, buy a boat, and sit on the lake for the rest of my life. Because that's what I look forward to, right? And some people,
we all know what your exit plan looks like.
Yeah, I'll see you guys on the lake. But with most people, when they do an acquisition, they put together an investment thesis of, hey, I think I can grow this business 20% if I cut costs or raise prices here and change the dynamic here. and then they accomplish it and they say, okay, I'm going to sell this thing and go do something else, right? They accomplish their thesis. But some people get the opportunity of family succession. They have children, they want to take over the business, or you just have random people calling you and saying, hey, I want to purchase. Is your business for sale? Like I just had two clients recently, like 2-3 months after they acquired a business, they were called up by two private equity groups that said, hey, like, I want to buy your business. And like, it was a complete shock to him because he just went through this whole exercise of 4 to 6 months of trying to acquire this thing. And then a few months later, someone wants to do the same thing and go through that whole exercise again. And, and then other cases too is, like some businesses, it just might make sense to just liquidate the business and move on, right? Like you have a bunch of, like you see that a lot with like truck businesses or like construction, like the machinery, like in that world is the machinery, the trucks, like that's where the equity is. And then it's like, I'm tired. Like I'm just going to sell everything. And they come out with a couple $1,000,000. I think my biggest recommendation for an exit plan is once you go through the acquisition and acquire the business, you'll have a deal room. I tell folks that continue that deal room, update it quarterly, right? New contracts, new financial statements, because someday someone might call you and say, you know what, for the right price, I will say yes, right? And if they meet that price, you got to go dig around for all these files and you have it there. And those files are always going to get asked for if you're meeting with an insurance broker, an attorney, just having a bunch of different conversations. But the big thing is just keep that deal room going and have that information on hand and kind of in its own spot.
So David, on that one where the private equity company came in and offered him to buy the company, did they say, okay, 10X?
No. He was emotionally not ready for it. But it made sense. It was a very niche industry and there weren't many of them. And it's like that's kind of you do something well, like people notice.
No,
But my
absolutely.
price would have been 20X, but
25.
It's
Guys,
like,
absolutely great points today. Dave, thanks so much for contributing to the podcast and to our listeners. Ben, I'd like to leave you with final thought before I wrap it up with next month's podcast.
yeah, I think we had a lot of good information on this podcast today. David, thanks for joining us and really talking about working capital. I think that's going to be valuable for anyone that's listening to this podcast to be able to take away. Number one, call David at Squash CPAs to help with their working capital calculation and their due diligence quality of earnings. But build that team, build that foundation, and continue that team on a go forward basis. That's what's going to lead you down the path of success. You just bought a business, you signed a personal guarantee, maybe you did an SBA loan, maybe you didn't, but now it's your baby for 5 to 10 years to grow it. So with that, I'm going to turn it over to Matt to tell us what our topic is for next month.
Well, I am super glad that we got through today, guys. Lots of great points. And to the listeners out there, Dave's a really, really good guy. And yes, we are hammering you hard today, sir.
Thanks for having me, guys.
Next month, we are going to focus in on wealth management. And you said, Dave, these are guys you want to have in your quarter. And we are absolutely blessed next month to have Ruben and Joe on from Strategic Wealth Management Partners here in Wisconsin. These are guys that have clients nationwide, and they know their stuff. So next podcast is going to be released late next month here in June 2025. As always, like, follow, and subscribe. We are on YouTube and Spotify. Guys, thanks so much. Have an absolute wonderful day, and I will leave you with that.
Happy Memorial Day.
Happy Memorial Day.
Thank you.
Thanks,
Great
guys.
job, Squash.